Hey everybody, Greg Barron. Thanks for joining us today. You're going to want to stick around because I'm going to tell you about 5 things that you want to avoid when purchasing any real estate. Stay tuned. So after almost 4 decades in the real estate business, there's 5 things that I can tell you that I would avoid when purchasing any kind of real estate. So here's number 1. Many investors count on appreciation that trumps cash flow, and it's the other way around. I've said this before in some of my videos, but the one thing that you do not want to do is assume that your property is going to appreciate over time. Cash flow is the number one thing you need to look at. I like to think of it this way. Think about baking a cake. A lot of due diligence, a lot of exercise goes into baking a cake. It takes the most time. The icing is the appreciation. So cash flow going in is the primary thing that you need to determine what it is going to be. And some people have different levels of return that they want. If you look at some of my prior videos, a lot of properties have different risk return expectations that they should have. If you've got a fully stabilized building, sometimes that cash flow or that cash on cash return is lower. If you've got a value add, then there's a little more risk associated with it, so your expected cash on cash return needs to be higher. At the end of the day, you just want to make sure that that property that you're acquiring or you're doing a value add-on is cash flowing from day one. Maybe you've got funded reserves that you also need to add, but never buy a property assuming that you're going to make your money on the appreciation. That model has not worked with a lot of people over the last few years, and that's one of the reasons that people like us that are back in the market looking at these deals, because these syndicators and these investors that didn't have a lot of knowledge or do a lot of due diligence are offloading their properties right now. Thank God for them, because if it wasn't for them, we wouldn't take advantage of this next round of properties that's going to be available. But buy for cash flow and let appreciation be the icing on that cake. Number 2 is investors make bad decisions on existing assumptions or on their own assumptions. I've often said you need to go in and constantly challenge your assumptions. Challenge the assumptions that you're given on the pro forma. And 2 additional things that I might add when you're talking about assumptions is make sure you're conservative. You always want to go in with more of a conservative pro forma than you do with a robust assumption, because if you've got investors involved, you want to underpromise and overperform. The other thing on challenging assumptions is you want to do multiple sensitivity analysis. So when you're modeling the particular acquisition or value add, you want to change your data points in that model. You want to change your vacancy rates to see what it does to your performance. In today's environment, and certainly over the next few years, you want to bump up those OPEX or those operating expenses year over year, because nothing's getting cheaper, especially property taxes. That's one thing that's been the bane of a lot of people's existence recently, is that we've had this property taxes that have just been out of control. You need to change those data points and look at it on a 3 and 5 year exit plan and see what it's going to do to your pro forma. So always challenge your assumptions. Never read your own press clippings going in. Do multiple sensitivity analysis. Number 3, and what's near and dear to my heart, is people do poor financial modeling and evaluation. Now, I've heard a lot of YouTubers out there say, we could look at a deal on a napkin and see if it's going to pencil out. Well, I give that a big bull hokey, if that's such a word. I'm not of the opinion that you want to do anything other than really diligent due diligence in the process of acquisition. I've seen so many of my peers, I've seen a lot of investors, I've seen a lot of syndicators that just do very poor financial modeling. So for me, we always use Performa Plus. That's a plug for the software. In many cases, we'll do it in conjunction with Excel, but I need something that's going to be error-free, that I don't have to worry about the formulas, and that it's not just some cheap performa that somebody's handed down 3 generations that I'm using. When I was on the bank board previously, I looked at hundreds of these things. And one of the first things that I had to do is really check to see if the data was correct. I needed to make sure that the formula calculations and the Excel were correct. So I would spend a day sometimes looking at these complicated financial models. But the first thing I would do is I don't care about the numbers yet. What I want to see, is there any circular errors? Is there any formula errors that might be corrupting really good information down the road? And the other thing that I look at in financial modeling is, do I have all the data that I need? Is there incomplete data that should be inserted in there? I've looked at a ton of these things, and there are many items that aren't included that should be. So get you a good system of financial modeling and anchor into it, and make sure you're not in the company of poor financial modelers. The fourth thing I would say is a mistake that a lot of investors make is they simply do poor research. Now, I love brokers. I love realtors. So many of them are my friends. So what I'm going to say right now, I don't want to offend a lot of you, but I'm going to offend some of you. A lot of the performance criteria that I see when they give me information, these big, bulky brochures, is I trust, but I verify. So like Ronald Reagan coined the phrase, trust, but verify. The bigger the sales brochure, probably the more they want to flower up the information. Do your own forensic due diligence. If you need some help on due diligence, connect with me, because I've got a whole chapter in my book, The Complete Guide to Commercial Real Estate Investing, on the checklist that you need to go through to do your own research. Especially when coming into a market like this, when there's going to be FOMO for a lot of years because projects won't pencil out. People are going to come to market and say, man, I've got this euphoria, I need to get into something. I want to tell you, tap the brakes. Make sure if you look at 50 of them, you're only going to choose 3 or 4 to look at, and deep dive into forensic due diligence on all of those. You don't want to get caught with your pants down and not do your homework when you could have done some additional research to make sure your project is going to make the grade. And the fifth mistake that investors make is they buy property in a region that they don't know enough about. Real estate is local. You can take the same type of asset and plunk it down on both sides of the road, and on one side it would do well and one side it would be really poor. You're not going to know those things unless you really know the region and the neighborhood that you're going into. A lot of people start buying properties. For example, I'm from the DFW area. They would buy a property in Memphis, or they'd buy a property in Oklahoma City, because the numbers that they get on the package on this mass mailing looks appealing to them. If you're just starting in this, the best place to start buying is in neighborhoods that you know everything about. You know the traffic flow, you know the neighborhood, you have a gut feeling of the demographics. There's a lot of things about buying local that will make a project successful because you know about it, and again, you've done your research. So don't make the mistake of buying in a market that you don't know anything about. Real estate is simply different in each region that you go to. Each region, each municipality, and in each neighborhood. Do as much research as you possibly can, and don't make the mistake of purchasing something where you know nothing about the locality. So I hope these 5 things have helped you not to make some of the same mistakes that so many people have that have come before you. If you follow these examples, you'll be much further along in having a project that will pencil out, that will hopefully build your wealth. If you're enjoying this material, make sure and let me know by liking and subscribing. And as always, remember, educate so you can evaluate to ultimately execute to increase your own personal wealth. We'll see you soon.